Hey, thanks for joining. Here's a question I was recently asked on my show, How to Retire on Time. Take a look. All right, let's talk about healthcare costs because that's the number one concern. And here is the fundamental problem. Insurance is not an investment. Could I say that more clearly? When you look at insurance, you've got different types, and let's define the different types just for what it's worth. You've got home and auto insurance, okay? The odds are not in your favor, and that's a good thing. People don't want their house to burn down or get hit by a tornado. People don't want, floods. Like, it's a hassle. Yeah, maybe insurance covers it. Maybe it doesn't. There's a lot of nuance there. People love to hate insurance, except for when it happens to you and the insurance company pays out.
Yeah.
But the odds are against you. Or if the insurance is very expensive. That's just how it works. With term life insurance, you don't buy term life insurance hoping you're going to die.
No.
That's a very dark situation. And even then, there are clauses in the insurance contract that says if that were to happen, we're not going to pay out. You have to want to live. The odds have to be against you. So, long-term care insurance is kind of what we're talking about, and Medicare. Don't treat this as a way to get more out of your money. Treat this as a way to protect your portfolio, but you're buying insurance. You're transferring risks to an insurance company. And for a lot of people, you might not need to do this. For some people, you may want to do this. Look, I've been doing this for over a decade. I've given a lot of long-term care illustrations to people. I have yet to sell a long-term care policy.
Because?
When you see the math, it's not as compelling. You put some money in there and there's a massive multiplier. So if you need long-term care, let's say for the first 15 years, it probably would have been wise, but no one knows. And if you don't use it, you probably would have more cash to pay for those healthcare costs later in your retirement. That's not mean by the insurance company. It's just how insurance works. The internal rate of return, which is kind of the most honest way, in my opinion, on how you can calculate this, it's just not very competitive. So what does that mean? That means some people are going to want to pay for it because it gives them more peace of mind. It's like, how do you spot an insurance salesperson? You say, hey, what do you do? And they say, I'm in the peace of mind business.
It's so cliche, isn't it? It's just, yeah.
But it's not wrong. It's just understanding the odds are not going to be against you. The people that I've actually tried to help get a long-term care policy, the traditional asset-based long-term care, you put money in, you get a multiplication out of that for like up to 5 years, 4 to 5 years or so, typically. They all got denied because the odds were now in the person's favor, not the insurance company's favor. And they're not taking on risks they don't know. So a fun way to say that is, how about you try and get a long-term care policy, and if they accept you, don't fund it, just cancel it. Don't just say, I changed my mind, and know that the odds are in your favor.
Yeah.
Don't do that, though. That wastes insurance companies' money. But but the other factor, hopefully people are just at home laughing because this is just truth, is you could use like an indexed universal life insurance policy. So if you qualify for certain parts for healthcare, that you could tap into your death benefit early. I mean, if you're going to hospice, you're kind of probably on your way out. There's a death benefit. You just got to structure the policy right, and you're going to use it as a cash value vehicle. So either use it for income, you can use it for your death benefit, you can use it for estate planning. It's kind of a Swiss Army knife, but anytime something tries to do everything, it does certain things not so well.
Yeah.
One of those is exceptional growth is gone.
Okay.
You're not going to beat the stock market over 20 years with a long-term or an indexed universal life insurance policy. Not going to happen. But it could beat your bond funds. Net of fees. It could beat your bond funds over a 15-year period of time. Not in the first 5 years. The fees are expensive. So then you have to ask yourself, what's the prepared reaction you want if you were to get sick early in retirement? What would the prepared reaction be if you were to get sick later? What are you okay with? What are you not okay with? Everyone's different.
Yeah.
But that's a way that you could do it. Another way to do it is to focus on IRA to Roth conversions. This one's not insurance. This is the self-insure plan. But if you're going to end up in a very expensive end-of-life situation, you don't want taxes to be an additional burden. So let's say you retire today, 25 years from now, you're now in hospice, okay? Your spouse has passed, you're in the single tax bracket, and you have major bills. In the single tax bracket, that's very unforgiving. And with high costs, you could either have kept a lot of assets in your IRA, you've got your RMDs to deal with, plus all these additional costs. So you've got a tax burden in addition to your healthcare cost burden, or you could have slowly done IRA to Roth conversions so that later in life, you're paying for healthcare costs tax-free, maybe from your Roth or maybe from your brokerage account. Long healthcare planning is quite complicated, actually.
Yeah.
You've got multiple layers of headwinds against you, not to mention the inflationary factors of healthcare. But it's an important factor. There's more than one way to solve it. The question is which one's right for you. And I don't know that an extensive amount of AI questions is going to get you just right there. I think AI is brilliant. I'm not, saying, oh, it's terrible, but AI is going to give you popular consensus of what is generally talked about online.
Right. Because that's what it's been trained on. That's the data. That's
Yeah.
it only knows what it gets, inputted into it.
Open up one of your AIs, just be for fun.
Okay.
Don't say who the AI is.
I won't.
You can
I won't reveal.
pick any of your favorites. I don't care which one, and just say, pretend I'm 65 years old, or no, pretend I'm 60 years old.
Okay.
Should I buy a long-term care policy, and if so, how much? Let's just see what it says. This would be kind of fun.
Should I buy a long-term care policy?
Yeah, say asset-based long-term care. Let's try and be more accurate with it. Just try and help it out. But these are huge things. Oh, the polls have changed, and now we have running out of money and healthcare costs tied for first. Market crashes. That's interesting. Maybe what we're talking about with a prepared reaction has helped some people uncheck that box. The polls are changing.
Yeah, it wouldn't be the first time. So pretend I'm 60 years old. Should I buy an asset-based long-term care policy?
Yeah, what's it going to say here?
Okay, it's
It's
currently
thinking. So there we go. Let it think.
Doing its thing here.
By the way, put in the chat or www.retireontime.com/ask if you want to submit any questions here. We'll be doing the last half of the show, answering your questions. Whatever you submit, anything pertains to retirement, we're gonna address them one by one. All right. So David, what does it say?
I must have it on high think.
All right.
All right, here we go. The honest answer for a hypothetical 6-year-old is it depends. And the factors it depends on are the whole game. Here's how I'd frame that decision rather than a yes or no. Okay, so
That's good. I appreciate where it's going.
Yeah, man, it's giving me a lot here. There's multiple paragraphs. I don't know if I can just sit and read all of this.
Yeah. Is there a summary at the end?
Okay, the case against buying one, you may be able to self-insure. The money could grow more if invested, and you're paying for guarantees you might not value. The case for it, it converts an open-ended, potentially catastrophic and hard-to-plan-for liability into a known cost, protects a spouse and the estate, and removes the emotional and logistical burden of family members having to fund or provide care.
And who's to say which is your priority?
Right.
People that make a career out of selling long-term care want you to buy it, and that's the answer they're going to recommend.
Yeah.
People who don't are going to say, oh, just self-insure, keep your assets into a portfolio that I charge 1% on, and you'll be fine. It's so biased. Really, there is no silver lining here. It's just whoever you're talking with. We try to do we do a lot of one-time plans. We just go down a series of questions, and honestly, whichever one fits for you, we're happy to do. But it's a very tricky question with a lot of sales influence in this industry, where half of the financial professionals want to sell it to you, and the other half say, no, keep it, self-insure, and we'll keep charging you 1%.
Well, surprisingly, this seems fairly thoughtful here.
That's good.
Yeah. He says none of this is a substitute for running the actual numbers against a specific balance sheet, income plan, and family situation, which is exactly the planning work that would drive the real recommendation.
Well, this isn't the first time that I've seen AI cite my articles. It used to be only on flat markets. No,
Right.
I'm joking. Well, it did take my research for flat markets, but on this one it might be a little bit different. But
Right.
yeah, plan first, explore your strategy second, and then pick the right tools for you. Has to be that way.
Hey, if you're listening in on this and you're going, gosh, I want to do it on my own, but I just want some guidelines. Look, if you go to retireontime.com, subscribe to our newsletter, you'll be a part of our first wave of our public subscribers. This is something we've held for our private clients. This is something we've been holding for a very special group of people, but we're making it more public for anyone that wants access. We're going to be launching that. You just have to subscribe to get first access to us. So go to retireontime.com, click subscribe to our newsletter, and you'll get access to the first wave of the public access to our models, the KDRC model, and so much more. All of it is intended to help you make better decisions as you prepare for retirement and retire.